Good morning, Central Florida. Let me ask you, do you know what kind of investor you are? Ever really thought about that? By the end of this show, you'll be better prepared to answer that question and a few more like, who am I? Where am I going? And what am I doing? Welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We are Central Florida's longest running radio program, coming to you on a host of radio stations throughout Central Florida. We're also one of the top 25 planning financial podcasts on the World Wide Web with over 20,000 downloads. Be sure to subscribe to our channel on your favorite social media podcast platform of choice. If you have any trouble finding us, just go to our website, nelsonfinancialplanning.com. Look in the upper right-hand corner, click on the icon that looks most familiar to you, and you will get instantly connected to our channel. My name is Rob Field. I am a certified financial fiduciary and a national Social Security advisor at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready to help you change your life this week with a successful and cost-effective financial plan. As you can tell, Joel Garris is off this week. He will be back next week with the next episode of Dollars and Cents. To my right, we're joined by Kristin Kalley, who's also a fellow certified financial fiduciary and a CPA. Good morning.
Morning, Rob. Thank you.
My pleasure. Glad that you are here. In the next hour, we're going to review what we call the 4 basic parts of creating your investment portfolio. This will entail your investment objective. What should you invest in? How can you fund your account? How you take money out? It's really a full circle conversation that'll take you from the beginning of investing to your later years in retirement. So let's start with the first part of creating that investment portfolio, establishing your investment objective. So this is where you set your goals and you start your plan. Your investment objective is going to depend on a variety of factors. Today we're going to cover 3 that we think are important and should apply to almost every portfolio. That'll be risk tolerance, time horizon, and performance expectations. So risk tolerance, why is that important? Well, it's really comparing volatility versus stability. How much fluctuation can I tolerate? How do I feel about changes in my account? Will I stick to my investment plan if the markets were to take an unexpected turn? Now, I'm not an investment genie with the crystal ball, but I can tell you that the market will go up and the market will go down. I just don't know how much or when, but it will. You're usually rewarded for a higher risk tolerance, but that's really up to you. The question is, will you stick to your personal plan if things get shaky, or will you suddenly change your mind when things get rough? Various investments will go up and down, and sometimes for reasons we don't even understand. What is your feeling on this, Kristin?
Yes, Rob, I completely agree. Risk tolerance is kind of the starting point of the financial planning process. So if you're unsure about what your risk tolerance is, there are some online quizzes and standard financial questionnaires that can kind of help you assess your stance on it. A popular one is the Global Portfolio Allocation Scoring System, or PASS for short. It provides a series of statements and you decide if you strongly agree, just agree, you're neutral on it, disagree, or you strongly disagree. Based upon your responses, you're given a score that aligns with a certain risk tolerance level. The higher your score, the higher your risk tolerance is. So you'll see statements like, I'm willing to tolerate sharp swings in my investments in order to seek a higher return, or statements like, I'm financially able to accept a lower level of liquidity in my portfolio. So actually, now is probably a good time to assess what your risk tolerance actually is. So the current bear market undoubtedly has caused some anxiety among all of us. But if the recent market volatility is causing you stress or giving you anxiety beyond a reasonable level, you should really consider changing your investments because, like Rob mentioned, the market will inevitably go up and down again.
That's true. Now, everyone's different. Everyone's financial situation's different. Your ability to accept risk really depends on various factors like your personal and psychological views on risk. Also, other factors like your time horizon. Now, Kristin, how does time horizon come into play?
So time horizon really drives whether you're looking for a short-term, intermediate term, or long-term investment. So let's give some examples of short-term horizon investment. So say 1 year or less. So you really shouldn't invest those funds in the market. So a good example of this is if you're saving for a down payment on a house. If you plan to purchase a home within the next year or even within the next 2 years, your time horizon is pretty short, and you should really reconsider just keeping those funds in your saving account. Although the returns on your savings account are pretty minimal at best right now, it's a safer holding spot for those funds. Now, if you're saving for a down payment and you don't think you're going to purchase a home for a couple years, say 4 or 5 years, then your time horizon's a bit longer and you can consider using, an investment account to help you save.
Yeah, it's interesting. It also makes sense. I was just dealing with the real estate market, looking at a potential purchase for myself, and things do move really fast. And what we did find, as you mentioned, if that market isn't cooperating with you, it happens to be down on the day that you need those down payment funds from your investments, it could be the difference between either getting that house, not getting that house, somebody beat you out for it. Tell me a little bit more about some longer term horizons.
So when it comes to retirement planning, time horizon is a big factor. So this is going to be more of what your long-term horizons should look like. So when you're a young investor, you can obviously take on some more risk than, say, an older investor about to retire. But when it comes to investing, especially for retirement, we really think it's a journey, not a sprint. So Rome wasn't built in one day, and neither will your portfolio. Your risk tolerance and time horizon will not remain stagnant. They should be reassessed every couple years just to make sure your portfolio is still aligned with your investment objectives. So take the current situation in the bear market we're in. If you're a young investor saving for retirement, this is merely just a bump in the road on your long journey. But if you're an older investor, hopefully you've reassessed your investment objectives over the past couple of years, rebalanced over time. So depending on your ever-changing time horizon and risk, hopefully your portfolio is in pretty good shape.
That makes sense. Now, wouldn't it be great if we had that crystal ball I was talking about that would help us predict the highs and predict the lows? So obviously, different investments are going to have different returns. How would all that affect your investment objective?
Absolutely. So we all know there's a trade-off between risk and reward. This goes both ways. So if you're sitting in cash and you expect your portfolio to be generating a certain level of income, or you expect it to grow to a certain level over time, that's probably not going to work. And you'll need to accept some risk in order to do that. And you'll even need to accept some risk to keep up with inflation nowadays. And this goes vice versa. So if you're in a very aggressive portfolio and you expect your portfolio to generate a steady level of income, you'll have to accept that you're going to see major swings in your balances, and you might not always have the right timing to make withdrawals.
Okay, so I think it would help to, first of all, be honest with yourself. Everyone says they want big returns and they want maximum growth, but when the markets become unpredictable and make large drops, we do learn our true tolerance level. The more upfront you are in setting goals and objectives, the better the outcome. And as Kristin alluded to, it is smart to manage your expectations. Now, you're also going to need to trust your advisor, and you're going to need to trust the markets. Your advisor really becomes your teammate, and then of course the market's the playing field that we use. If you can trust your investment strategy, then trust it for the full investment game. You're pointed in the right direction. And really, history has shown us that markets do perform very well in the long run. You just got to trust history. I mean, it's just the facts right there. It tells us what we want based on history. Listen to what your advisor tells you, and then I think overall you're pointed the right direction. So we're going to segue into another area that we think is very important. That's actually going to be, what should you invest in? And right off the bat, we're going to tell you it's not a cookie cutter approach. Every situation is unique. You got a lot of options. You got unlimited access to all kinds of investment vehicles. We've seen many of these online pre-generated asset allocation models. You answer a few basic questions, it spits out an allocation. We're going to go into more detail on that after this break. You are listening to Dollars and Cents here in Central Florida. Stick around, we'll be right back. All right, welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We are Central Florida's longest running radio program here in Central Florida, also a top 25 financial planning podcast. Before the break, we were talking a little bit about what you should invest in. We know that there's a variety of online pre-generated asset allocation models that people use. You answer a couple of basic questions, it spits out something for you. A lot of times there's no real thought or consideration into you or your personal circumstances. We know this can be a good baseline. It's a starting point, but again, one size does not fit all. So there's really no right or wrong answer when it comes to investing. The key is to do it. But as financial planners, our goal is to help you, guide you, kind of point you the right direction, give you some good recommendations. Now, with that said, when I am making a recommendation to you, I'm going to try not to tell you what I think is important. I'm going to really try to do a better job of asking you what you think is important. And then, I'm not going to tell you what you want. I'm going to listen. Hopefully you'll explain to me what you want, and then we work together, kind of come up with that plan. I think it's the only way for me to really understand what you want and then kind of point you the right direction. So when we're picking investments, it can be a lot like, purchasing a car. You go into the dealership, you grab your salesman, you tell them kind of what you want. I want these features. I want a car that's big or small, fast. I needs to hold people, not too many people, maybe a convertible. From there, you give them that information. You can kind of hone it down and say, okay, well, over here are some cars that kind of meet that parameter. These are things that you share with the salesman. When it comes to investing, we want you to share the same thing. We want you to kind of tell us, what direction you're trying to go, what's on your mind. We'll then try to help you navigate. I like to think of it as, the client or the potential investor is a driver, and we're the GPS system. We're going to kind of help you navigate through all of your options and then get you pointed to the right direction. So when we talk about investment options, what are some options that people have?
So we're just going to go over the 3 basic investments today. So there's stocks, bonds, and mutual funds. So we're just going to start with stocks or equities. So we're going to go back to the basics. Kind of the textbook definition of a stock is you're buying an ownership or equity interest in a particular company. You then become a stock owner of the company and share in the company's success, whether that's through dividend payments or price growth or both. So you can buy stocks on any sort of brokerage platform. They're available pretty widely. When it comes to stocks, we divide companies into 3 different buckets. We have growth companies, value companies, or blended companies. Growth, just like it sounds, are suited for investors who are more focused on capital appreciation. Growth stocks are companies that are seeking to increase their revenue at a faster rate than the average business in their industry. So they tend to be more innovative. Good examples of this include Tesla, Netflix, Meta, Alphabet, and so on. These stocks may sometimes pay a dividend, but the returns usually come from the price growth of the stock. So kind of moving on to value stocks, these are kind of the counterpart to the growth funds. They tend to be companies that are a little bit more mature businesses with steady growth rates and relatively stable revenues and earnings. They typically pay a dividend, so good examples of value stocks could be Procter & Gamble, Target, Disney, and so on. Blended stocks are companies that fall into both categories, the growth and the value categories. So we call them blended funds. A great example of this is Microsoft. So they obviously are doing innovative products, but they pay out a steady dividend, and they're ongoing with new products and innovation.
Yeah, it's interesting. Along with equities, sort of the flip of that is what we would refer to as fixed income. And these are investments that are more designed to either generate income, a little bit safer, less volatility. Some examples of that would be just your savings account at the bank. That's if there's a fixed income amount, they're telling you how much you're going to earn. You put the money in and away it goes. Not a high rate, but it is an option. Banks also provide CDs where if you're willing to park your money with them, they'll guarantee a rate over a period of time. There's money markets that are available. These are usually a little higher paying. Maybe they offer some checking options. And then you get into your actual bonds. You got government bonds that are issued by the government. That's how they generate some cash to do some of the things that the government does. Those are attractive because they're guaranteed by the government itself. It is a fixed income. If you held it long enough, you'd actually know exactly what you would get from what you bought it to what you could sell it for. Not a great rate, not really designed for long term, but it's an option. Going up the chain, there are corporate bonds. Now companies, as they are generating revenue to expand, they obviously could do equities and issue stock like you were just talking about, but they also will do corporate bonds. They'll simply say, okay, we're gonna lend us some money, pay you some interest over time, and then at some point we'll pay you back. All of these are viable, not necessarily going to give you the greatest long-term return, but available either way. They're sensitive to interest rate changes. So you do want to keep in mind that if you buy a bond, it has a price. That price can fluctuate if new interest rates coming out happen to change bond price to create what we call parity, make it the fact so that, let's make this bond similar to the new bond, I might have to change the price. So something to keep in mind. So we've looked at stocks, equities. We've talked a little bit about fixed income. You could go out and you could say, okay, buy into stocks. I'm going to go out and pick a couple stocks and hope they do well. Could be not necessarily gambling, but you certainly don't have you got a lot of eggs and they're all in one basket. We sometimes will refer to mutual funds. And then the concept of mutual fund is, hey, instead of me buying one stock and hope it does well, I'm going to pool my money with some other investors. We're all going to then buy a handful of stocks, and we're going to hope that through diversification and some management that maybe it'll provide some options that would be better for us. Can you tell me a little bit more about mutual funds?
Just like you said, Rob, the mutual funds, we see them as a pretty diversified option, and usually they're less risky than owning individual stocks. So just like you said, it's a bucket of stocks or bonds, and each mutual fund itself has a particular objective. Kind of going back to what I talked about earlier, there could be mutual funds with the objective of growth or value or blended sort of investments. And mutual funds can be actively managed, which means there's a team of portfolio managers that buys and sells the companies that you're owning within the mutual fund on a day-to-day basis. So that means that mutual funds typically have some internal expenses and fees associated with them.
All right, yeah, we're big fans of mutual funds. We find that a great way to invest. I think simplicity is something that I like. Low cost is something that I think is a must if you're doing your investments. Obviously you have liquidity, easy to get in, easy to get out. I think the list is really fantastic. So with a mutual fund, got all those great options. What about taxes? How would that come into play with a mutual fund?
So with mutual funds, taxes work on a pretty annual basis. So mutual funds have dividends, interest, and capital gains that will flow through to your individual tax return. So kind of running through the three different types of investments, we'll kind of run through the tax consequences for each of those. So when it comes to retirement accounts, everything in that sort of account grows tax deferred, so you won't see any tax implications until you take out the money. So let's just talk about regular investment accounts for now. So stocks usually pay a dividend that will be taxed on your tax return, whether or not you decide to take the dividends as cash, or if you decide to reinvest them, they're still going to be taxable on your tax return. Similarly, bonds pay interest, which will also be taxed on your tax return. Like I just mentioned, mutual funds have a combination of all that. They have dividends, interest, and capital gains that will flow through to your tax return. So similar to any sort of asset sale, so if you sell a home, it's an asset sale. Stocks, mutual funds, you will have to report a gain or loss, whether it be short-term or long-term, on your tax return if you decide to sell the investment. So short-term is going to be taxed at your ordinary income rates, which depends on whatever your tax bracket ends up being for that tax year, whereas long-term is taxed at preferential rates. So those are the capital gain rates that are 0, 15, or 20%. So if you're looking to buy and sell stocks on a regular basis, you should expect to owe some taxes on the capital gains. But if you're in a higher tax bracket, there are some other investment options out there. So municipal bonds are sometimes a good investment option if you fall into those higher tax brackets. So these are bonds issued by states and are usually they are free from federal taxes and usually free from state taxes, kind of depending on the state's laws themselves. So these are, like Rob mentioned before, bonds, fixed income. So a good option if you have the higher income tax brackets.
Wow, okay, so we've been talking this last segment about what should you invest in. It's not real simple to just pick one and run with it. You got a lot of options, and again, those options and what you select, I guess depends on how well they communicate with us and what they want to do. So obviously very important. What are you going to invest in? You have some things that you can choose from. When you sit down with us, we'll help you kind of ascertain which one might be the best for you. All right, heading to the break. You are listening to Dollars and Cents. Be back shortly. Welcome back to Dollars and Cents, where we help you make decisions out of all of life's dollars, everything that involves in investing. My name is Rob Field. I'm a certified financial fiduciary here at Nelson Financial Planning. To my right, Kristin Kalley, also a fellow certified financial fiduciary. First two segments, we talked a little bit about determining, really what kind of investor are you, and kind of help you make some decisions to get started on that investment journey. Then we shifted over, talked a little bit about what can you invest in, what are your options, what type of investments might be appropriate for you, how do we match up to your goals. We're going to shift into the third step of building that investment portfolio, and that's basically going to be built on deciding how you're going to fund your investments. You kind of know who you are, you know what you might want to use to hit your goals, so how are we going to get that money in? So there's really 4 steps when it comes to funding your investments. First one would be to set your goals. What are you trying to do, and how are we going to achieve that? Got to create a budget, because we got to at some point figure out how the heck we're going to put money into these investments, so you got to decide how much and how often. Going to decide on which account to put it into. So again, we talked about you have some variety. Got to find out then which of those would be the most appropriate for you, and then determine when and how often you will invest. Got to have a system for getting that money in. Now, I always like to tell people when they're putting together their budget, try to pay yourself first, as in make the money that you're going to set aside for your investments, get that at the top of the list. Very easy to say, well, between rent and mortgage and car and food and going out, if the last thing on the list is how you're going to have some money going to your investments, a lot of times it gets lopped off, and then retirement comes around, you didn't save as much as you want. So set that goal, get that budget, decide what you want, make sure you pay yourself first. So when we talk about setting goals, Kristin, could you share a couple of ideas on ways you could do that?
Absolutely. So when it comes to retirement, your goal should really be to kind of keep living at the same standard of level of income that you've been living at before you retired. So we aren't interested in changing your lifestyle in retirement. In fact, you'll probably spend more, you'll have more free time. So the goal really is to kind of get your income to the same level it was before you retire. So a good starting point is to consider what your gross salary is right now. So let's just take a hypothetical example to kind of run through how we'd figure out what your goal should be. So hypotheticals, a family of two is generating out $100,000 of gross salary between the two of them. So in retirement, you don't necessarily need to generate out that same $100,000 of income to live at the same standard. And here's why. So when you're working, you will have Social Security and Medicare taxes taken out of your salary, which amount to about 7.65% or so. And you're also probably contributing to your 401k and also your deferred compensation plans. So let's just say for conversation purposes, you're contributing to those at a rate of about 10%. So this probably drops your net pay down to about $80,000. So you're thinking you're going to need $100,000 in retirement when actually you're actually receiving net pay closer to $80,000. So you'll also want to consider your Social Security benefits, which will further reduce what you'll need to generate out from your portfolio to continue living at that same standard of living. So let's say in this case, the family is going to receive about $20,000 of Social Security. So that actually leaves us with about $60,000 that we're going to need to generate out of the portfolio to provide income during retirement. So from there, it's just a quick analysis that takes into consideration how much you have saved now, how much you're saving annually, and how many years until retirement.
All right, so looks like cash flow analysis will be very important to kind of get that trail of how the money's flowing. So how do you know how much you actually need to save?
Right, so a good rule of thumb is to save between 10 to 13% of your gross salary for retirement. So if you started saving later in life, this may actually be a little bit of a higher rate, but we can really drill down into more exact amounts using kind of that analysis that I hinted at before. And this is really encouraged for people that are a few years out from retirement. So for example purposes, we'll go back to the previous scenario. So the client previously generating about $100,000 of gross income, he's looking to generate about $60,000 off his investments in retirement to keep that same standard of living. So the analysis, we're going to go through two different scenarios. So let's say he's on track for retirement, he's got about 10 years out, he's got a pretty big nest egg saved up, his savings currently and annually are doing what they need to, and he's on track for retirement. But on the other hand, let's say his retirement savings are on the lower side, and the analysis came out showing that he needs to save an additional $30,000 a year to retire at the same level of income. So this is a very, very dramatic shift. So this is where we would kind of throw out alternative goals. We would say, maybe consider pushing out retirement a few years or lower your anticipated retirement income expectations, things like that. There's plenty of online cash flow calculators online that'll run these numbers for you. We can also run these numbers for you. We do them on a daily basis here just to help you know if you're on track or if you need to save more or adjust your goals.
Sounds like a good tool for sort of getting it all organized and then maybe have it in print, something that they can refer back to as time goes on. All right, so Kristin, we've figured out our retirement budget. We know how much we think we would need to save to meet our goals. So what type of accounts should investors actually be looking at?
So there's really two categories. There's retirement accounts and then just regular investment accounts. So we're going to first run through your different type of retirement account options. So the 401k is probably the most popular option. So these are employer-sponsored plans that usually allow you to set a percentage of your paycheck to be automatically deposited into your 401k plan. So it makes it very, very simple to invest. It's just automatically taken out of your paycheck before you even receive the funds. In many cases, you can receive an employer match for a portion of your contributions. So that's basically like getting free money from your employer. It's a great benefit. Nowadays, there's pre-tax 401ks and there's also Roth 401ks. Between the two, you can't contribute more than $20,500 a year or $27,000 if you're over 50. So there's also IRA accounts. So IRA accounts are similar to 401k accounts, but these are accounts that you open for yourself and they're not opened by your employer. So when you stop working, you can roll over your 401k into an IRA. IRAs usually have more investment options because you're not limited to what is available on your employer's plan. You can establish a traditional IRA or a Roth IRA. Between the two, the maximum contribution is $6,000 a year or $7,000 a year if you're over 50. There's also SEP IRAs. These are for self-employed individuals. So it's also similar to a 401k, but it's for anyone that owns their own business. The contribution limits are the lesser of 25% of your compensation or net profit, or $61,000. So you got a pretty good contribution limit there. The alternative to retirement accounts are just regular investment accounts. So as you notice with each of these retirement accounts, there is a limit to how much you could contribute a year. So if you want to contribute over those amounts, or if you just like to diversify your holdings, a traditional investment account is a great option.
It sounds like you got retirement accounts, non-retirement accounts. You kind of choose what's best for you. But when you think about that, what would be the tax implications for these different kind of accounts?
So each of them has different tax implications. So retirement accounts, we'll just start there. So if you have a pre-tax 401k, or if you have a traditional IRA or a SEP IRA, these all operate pretty similarly when it comes to taxes. So your contributions will reduce your taxable income, which in turn reduces your taxes for the current year. So it's an immediate tax benefit. Your contributions will grow tax deferred until you withdraw them. Anything you withdraw is going to be taxed at your ordinary income rate, so it just depends on whatever your tax bracket is for that year. Depending on whether you take out more money or less, your tax bracket will fluctuate. And usually in retirement, your tax bracket does go down, so it's a good benefit. You also have Roth 401ks and Roth IRAs. So these operate similar to each other, in which your contributions do not reduce your taxable income, but they grow tax-free and can be withdrawn tax-free. So you don't get an immediate tax benefit like with the pre-tax accounts, but you do get a future benefit, and it's a pretty good benefit. So the alternative to the retirement accounts are investment accounts. So this depends on whether you've held the asset for a long-term period or a short-term period. Long-term period receives the preferential capital gain rates, which we talked about a little bit earlier. That's the 0, 15, or 20% tax rates. And then ordinary is going to be taxed at your ordinary income bracket, whatever that ends up being for the year.
Okay, that makes sense. All right, we are coming up on the break. You are listening to Dollars and Cents here in Central Florida. We'll continue this conversation in just a few minutes. Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your investment dollars. Reminding you, we are Central Florida's longest running radio program, available on a host of radio stations throughout Central Florida, also a top 25 financial planning podcast on the World Wide Web. Before the break, Kristin was telling us a little bit about some different things on selecting investments and the tax implications. We know you could talk about retirement plans, non-retirement plans, talked a little bit about how the taxes would affect each one of those. Go a little deeper into how and when do we actually invest this money that we're talking about?
So when it comes to funding your accounts, it's time in the market that really matters, not trying to time the market. So the more you save today, the more time your investment has to grow and accumulate over time. So we just saw this in the prior example from the prior segment. So saving consistently along the way provides a more favorable situation, whereas the client that was trying to generate out the same level of income but didn't start saving till later in life ended up having to save about 1/3 of his salary towards the end. So it's really important to kind of just save along the way, even if it's just a little amount here and there. So we all know that the market has volatility, and we are seeing this today on a daily basis, but timing really isn't that critical to long-term success. So even selecting the worst day of the year to invest, someone who continues investing in the market over the past 20 years would have come out ahead.
That's great. Nice to know that that plan can work. One area I found helpful when we talk about putting the money into the investments is to maybe utilize what we call dollar cost averaging, a system where you're, instead of saying I'm going to just put a lump sum amount of money into an investment, I'm going to slowly add small pieces into it. Usually it's on a monthly basis, consistent, same time every month, same amount, and just keep it going. Easy to do, easy to set up. Dollar cost averaging, three things are going to occur. All three are to your benefit. If you're slowly putting money into the market and the market continues to go up, you're buying into a market, your performance is going to be great. If you are slowly adding money on a consistent basis, systematically, and the market kind of remains flat for a while, that's okay too. You're loading up, and then when the market does make its move, you'll have plenty of assets invested that'll take advantage of it. Third scenario that people always get concerned, like, oh, well, what if the market goes down and I'm buying in the down market? You're actually going to get a lower average cost. And since we know the market over time does go up, does give you some great returns, if you get a chance to buy some of it on sale, slight discount, and then later on take advantage of it going up, I think that's pretty beneficial. One thing about investing I did want to throw out is it doesn't mean you don't have to be extremely active to be successful. It doesn't mean that you've got to buy stocks, sell stocks on a daily basis, be a trader, do options, things like that. A lot of times slow and steady will win the race. Just simply listen to your financial advisor, pick investments that are good for you for the long term, and stick with it. A lot of people view investing as sort of like working out at the gym. I got to get in there, I got to go often. It's the more activity I do, then the better my results are going to be. And it's not always the same thing for investing. It doesn't always carry over. Okay, so we talked about in the beginning, who are you? What kind of investor are you? What are your options? How are you going to actually fund your investments as you move along? And then the exciting part is we've saved this money for something, basically probably retirement. So our next section on kind of how do you build your successful investment plan is what's the best way to generate income? At this point, how do we make these investments work for us? Really 4 steps you want to go through as you kind of get to the best way for you to generate income. First, you want to analyze your savings. How much have you saved? You spent some time picking the right investments. You've picked some time adding money to it. Where are we? Next step, review your goals. Goals are a little different. We had goals to invest. Now our goals are retirement, income, live our lives, say post-work. With that, you got to develop a budget. This budget now is for how do I utilize the money? Not how am I going to budget the money I'm making, but how am I going to budget the money that I've saved? And then the last piece would be determine your desired income. How much income do I want? How much income can I get? Now, general question I hear a lot, you probably do too, is, how soon can I retire? Do I have enough to retire? Could I retire today? The answer really is kind of up to you. Yes, you could retire today. Anybody could retire at any given time. It's kind of, you got to ask yourself the question, I guess, of what does retirement look like to you? What do you want to do in retirement? And then the investments you've saved, are you at a point where you can achieve those goals? So like I say, you got to take in consideration what retirement looks like for you. How much income are you thinking about getting? Where are you going to pull that income from? Kristin talked about some different investments. Each one has its own unique way. A couple of options for income are going to be Social Security, obviously your investment portfolio that you built, and then maybe you're going to have a part-time job. Now for Social Security, most people qualify for that. If you have worked at least 10 years total, not even consecutive, you qualify to get some type of payment from the government in the form of Social Security. Now, it's typically not going to replace all of your income, but if you've worked a number of years and your average income has continued to grow, it could be a substantial amount of money. Definitely going to be a part that you're going to want to consider of your total income as you move into retirement. So Social Security is something you want to think about. We would be glad to help you optimize, look at your numbers, and tell you how that's going to fit in with your total plan. But Kristin, what are some other places that people could pull income from in addition to that Social Security?
So your investment portfolio. So the funds that you've been saving for the past couple of years, you're finally ready to start pulling some income off of them. But before anybody retires, we encourage them to really just take a look at what their retirement assets really are and figure out a comfortable withdrawal rate. There's really no magic number, but we typically recommend that you hover around 4%. So your retirement account is not a cookie jar. Taking out large chunks, especially early on, can really deplete your balance and eat away at your principal. So we obviously want you to enjoy retirement and spend your money, but it's important to keep the bigger picture in mind of how long these assets have to last you. So taking into account the average lifespan is 77 years old, and for women, it's actually 83 years old. So another option is part-time work. So some like to return back to the workforce just on a part-time basis, maybe taking up something that they enjoy, but didn't necessarily want to pursue a career in. So part-time income can help supplement your retirement income. So Rob, isn't there a limit to how much you can make with a part-time job if you are collecting Social Security?
Correct. There's a limit to how much you can make while you're collecting Social Security from an income and not have your Social Security actually reduced. So, anytime after 62, you can start collecting Social Security. That would be the lowest amount. But if you're working, you want to keep in mind how much income you might make. So from age 62 until you hit the year you would start or would be considered your full retirement age, and it's somewhere between age 66 and 67, depending on when you were born. During that time frame, you can really only make about $20,000 before Social Security would start withholding $1 for every two that's above that amount. So you want to keep that in mind. A lot of people say, I'm going to retire early and I'm going to start my Social Security, and if your income is at a certain level, you're going to give up a lot of the Social Security. So you started early and then you didn't really ever get to benefit from it. Now, once you hit the year that you're going to be in full retirement, at that point during that year, you can make up to around $50,000 and still not have your Social Security reduced. And then once you actually hit full retirement age, the actual month of your specific full retirement age, then you're unlimited. At that point, you can make any kind of income you want. Social Security is not going to pull back or not reduce your Social Security. So Kristin, I'm gonna flip it back to you. Same question I keep asking you throughout the show. What about taxes? So how will taxes affect the income that you take?
So once you retire, you're not going to have an employer doing your tax withholding for you. So it's kind of up to you to figure out what tax bracket you're going to fall into, if you should be saving or withholding along the way, or if you plan to pay your full tax bill on April 15th. Either way, you kind of got a budget for these taxes. So in the last segment, we discussed the various accounts that you can own to fund your retirement, each with that different tax structure. So there's really 3 different buckets. You have your pre-tax assets, you have your post-tax assets, which are your Roth assets, and then you have just your regular investment account assets, each with different rates. So we really think it's a good strategy to use all these different buckets to your advantage to kind of keep your tax bracket low.
Sure does make sense. What we've shared with you today is not really a homework assignment where you got to go home, make decisions, and you're on your own. Really gave you some ideas. Think about what we said. Give us a call. Let us put you in the right direction. Again, our goal, help change your life with a successful financial plan. You're listening to Dollars and Cents here in Central Florida. Join us again next week. Joel will be back as our host.